Good afternoon. This is Dwayne Lowry for the DPP Grain Desk on Sunday, March 11th. First of all, let's talk a little bit about what to expect here tonight. Then we're going to talk a little bit about the report from USDA that we had this past week and inform us acreage numbers and outlook. And then we're going to talk a little bit about the big picture possibilities here. As far as tonight is concerned, I don't think there's a lot here for news. I think the important focus on the trade is going to come from a few different angles depending on what traders' perspectives are. Some will look at Friday's price action performance as encouraging. Others will see it as disappointing. In terms of weather, we've got a very warm 2-week outlook for most of the U.S. Ahead of us, and that's been the pattern, and it's believed that that's going to continue to be a general overriding theme for this spring. Moisture this week will be somewhat subdued across the Midwest and the Delta. There'll be a little bit of a system moving through, but not real significant. The 6 to 15 day period offers much improvement in moisture for all of the U.S. plains, which will be beneficial, and the northwestern Midwest, which would also be beneficial. We've had some of these rains in the forecast before, but they haven't always materialized, so it will be important that those rains and moisture improvement do develop. But the overall theme here is pointing towards an early spring, and I think that that's becoming more accepted in the grain trade arena, that people are looking towards maybe a favorable or early spring for this year. I think on the overall backdrop, that's a bearish input. I don't think that's a bullish input. I think that will lead to maximum acreage. It'll lead to minimal flooding or loss of prevented plant acres, which will be different than we had last year. So it's a very good outlook if you're looking for maximum production potential here in 2012. So I think the weather is a little bit bearish. Outside markets provided some support to the grain trade on Friday. Crude, gold was up for like 3 days in a row. The stock market performed reasonably well, even though it's lofty and due for some sort of corrective activity. But these outside markets may be short-lived in their support of the grain trade. One of the things that I've talked about quite a bit over the last few months is a supportive U.S. dollar outlook and expectations that the dollar is going to strengthen. The dollar had an impressive week the last couple of weeks, and in fact, just to give you a perspective, Friday's close in the U.S. dollar index, if you compare it to other Friday closes going back to January of 2011, almost 15 months ago, there's only been 6 Fridays, 6 weekly closes that have been higher than where we finished that dollar index on Friday. That's going to, or it has been weighing on overall commodity sentiment and how global speculators position for what they see the future to hold. And I think that is a move away from general commodity buying. I think that's been going on for several months, and I think you're seeing more confirmation of that and more embrace of that thinking here as we go along. So I think the outside markets here may soon be a drag on commodity sentiment. Wouldn't surprise me if gold, crude oil saw a weakness here this week develop and extend over the next several weeks, and it wouldn't surprise me if the stock market soon experience some sort of a notable correction event. As far as the last week's USDA data, statistically speaking, the data was largely insignificant. They left U.S. corn and bean carryout figures and the supply and demand tables largely unchanged from the month before. In relationship to expectations, a certain amount of disappointment associated with that. But on the big picture here, we do not have a supply threat storyline for this year in corn or beans. It is possible that beans will be more sensitive to growing season concerns this year than corn, just because it's going to have a more tight, delicate balance situation. Next year, 2013 and beyond, it's going to be necessary for U.S. And or South American soybean acreage to increase. In the case of the U.S., if we have a good growing season, a normal yield in corn this year, 2012, our carryout levels will go up to at least 1.5 billion or more, and it will also create a situation where we can lose 4 million acres of corn in 2013 from what we plant in 2012, and still produce an unchanged carryout situation in 2013. So the the opportunity to shift some acres for 2013 towards soybeans certainly could be there, and it could occur relatively painlessly. I say painlessly in terms of being able to get those acres to shift. The problem is, to the extent that you want to be bullish beans because of an acreage concern for 2013 and beyond, that's also a bearish statement about corn, because if you get a good growing season in 2012 and you are able to shift acres over to beans in 13, part of that is going to occur through the marketplace shifting profitability away from corn and towards soybeans, and most likely that will occur to a large part by a sharp reduction in profitability that corn prices have offered over the last several years. So that should be a longer term concern in terms of profitability towards corn. As far as acreage is concerned, Informa on Friday increased both corn and beans from their month ago estimates, and I think this is a reflection of favorable spring conditions, and there's been a general belief that as we get more into the spring, there's a good chance that the total planted acreage is going to be going up as CRP acres come out, spring optimism occurs, etc., as some of the winter estimates were seen as relatively conservative. So as we look ahead here, I continue to see a very significant threat to profitability, producer profitability. I see a significant threat to downside price risk, especially in corn, an anchor on wheat, and to a lesser extent on soybeans. But at the same time, I am amazed that the general trade attitude here is extremely bullish corn. I say that not so much that they think prices are going $1 higher, but they're extremely unwilling to be bearish. Maybe that's a better depiction of the reality here. There is no fear of downside risk. They do not think prices can break very much. That is reflected in a producer that still is a relatively tight holder of old crop corn, and if the general trade is correct and prices stagnate sideways here through the planting season, absorb whatever favorable conditions there are, but do it without weakening prices very much, then I suppose that you're ready for some sort of a summer weather scare. I think the greater concern here, which I don't think there's enough respect given, is the possibility that between now and the end of the planting season, basically between now and the end of May, that prices absorb a favorable start to the growing season, a greater concentration of focus on new crop supply-demand balance sheet in corn and a rising carryout, and we find prices between now and then will experience a significant price decline. If you look at the charts have been stagnating for some time, but they are continuing to threaten an unraveling and a rolling over of values. In the last couple of weeks, there was a lot of speculative length added to the corn market, and yet price action has greatly underperformed expectations. The USDA reports were neutral and a disappointment, and while Friday's price action was volatile and choppy, corn only managed to close 4 higher, and that was after breaking 30-some cents from the Monday's high. So there's a very significant threat here. Most aren't reading it that way, but that's how I see it. And I think that a guy has to be very careful, very respectful of downside risk, and make sure, especially on old crop inventory, that you're fully factoring in just how much risk you have with unsold inventory here. For the DPP Green Desk, this has been Dwayne Lowry. Thank you.